The Hedgeless Horseman here. It's January the 17th, 2023. I thought I'd make a video uh, discussing mindset and beliefs. I'm currently reading a book. I think it's called Limitless Unleashing the Potential, something like that. Anyway, it basically has to do with, psychology and, of course, beliefs, mindset, how the mind works, what kind of, let's say self-talk, what you tell yourselves, what you tell yourself, and how that may hurt or help you, etc., etc. And I just thought at least this page with a segment here was very interesting from an investor's point of view, because when you think about it, we have a bunch of mindsets and beliefs how the market works, how you should go about investing, etc. And a lot of that is actually false, or let's say bad beliefs, and hence why most people do not, or can't beat the market or beat an index over the long term. Why is that? It's because we believe a bunch of stuff that directs our actions, and those beliefs are bad beliefs to begin with. So we basically, if we have a belief, we obviously do or act in accordance to that belief. So I just first of all want to read this part here. The first element of the three-part limitless model is mindset, which is the mental attitude or disposition that predetermines a person's response to and the interpretations of situations. Mindset is made up of beliefs, assumptions, and attitudes we hold about ourselves and the world around us. All behavior is driven by beliefs. So before we address how to learn, we must first address the underlying beliefs we hold about what is possible. Um, and I have written about or talked about some of this stuff before, but it's like, first of all, and this is something I mentioned a couple of times. I mean, uh, it's quite obvious that everybody and their mother wants a so-called 10 bagger. That is that is basically how you get good returns. You buy stocks that end up going up hundreds of percent, and that is pretty much the only way you can have really good returns. I mean, obviously that's not the case, because a 10 bagger typically becomes a 10 bagger over years. And if you just found companies where you think there's a high probability of 50 to 100% over the next 1 to 2 years, your portfolio would 10 bag, even though you wouldn't actually perhaps ever owned a stock that became a 10 bagger. I mean, the actual goal is, when you think about it, it's not to find 10 baggers, it's to find cases where you could uh, cumulative get a 10 bagger in your portfolio over, let's say, 10 years. Or, I mean, 5 would be even better, obviously. So that's also a kind of a false belief that you need a bunch of 10 baggers to have good results. Uh, and that is actually not really the case. Or rather, you will know if it's a 10 bagger long after you buy it, because it typically takes years to actually for it to actually become a 10 bagger. So I just wrote down some stuff that I think it's good things to think about, and how actually our belief dictates a lot of what we do or how we think, and why that is well, often leads us astray. I would say that the preeminent vision or belief of how a 10 bagger happens or should happen is that they happen quickly, never correct the need to be extremely risky to begin with. Uh, I think you would all agree that when you see somebody mention this has 10 bagger potential, typically it's a micro cap. I mean, that kind of makes sense, obviously, but it's like they're also typically very risky. If they hit here, for example, then it could become a 10 bagger. So basically, they are typically presented as, if somebody says, hey, what could be a 10 bagger, etc. The response you get, or what people offer up as potential opportunities of a 10 bagger, is typically pre-discovery plays where there's a very large if, and typically a very low probability of if this happens, then it could be a 10 bagger. And of course, to make an actual discovery, a discovery hole on a maiden drill campaign, let's say, that's a very low chance of happening. And again, most 10 baggers do not happen quickly. Most 10 baggers might take at least 3 years on average. 3 years at least. Basically, you would need to buy and hold a stock for 3 years without selling for it to become a 10 bagger. And it's like right here. Basically what I just covered. But a 10 bagger is an event. That's what people believe. A 10 bagger is an event and not a process over time, where a 2 bagger becomes another 2 bagger, etc. That also includes multiple corrections along the way. I mean, you will see that in any stock that actually becomes a 10 bagger over 3 years. As soon as it has let's say a significant correction, which will happen. I mean, we know Rick Ruler said every company he has owned that became a 10 bagger or more had at least, I think, 50% corrections. But every time that happens, people think the sky is falling. Because for some reason, when it comes to 10 baggers, people don't believe that a correction, it doesn't fit with the whole, 10 bagger thing. Because again, you expect it to just go up until it becomes a 10 bagger in just 3 months or whatever. And that also ties into everybody's hunting for a 10 bagger, but most sell out after a double or can't stand a single correction. That's what fascinates me, kinda. That the very people who say they are actively hunting for 10 baggers, it's like they haven't thought it through, because they have no idea how a 10 bagger actually happens. That it is not an event, that it is a process. And if you sell after a double, which I see people do constantly, oh, I got my 50 to 100% return, time to sell. Because there might be a correction. Oh, it's gone up already. And I'll go into that later with the whole, everybody's short-term focused and can't stand a single correction. So if you can't stand if you can't stand owning a stock that goes down 50%, you'll never have a 10 bagger. If you sell out every stock after it has doubled, you will never have a 10 bagger. Even if you even if you sell out after a double has become a double, you will by default never have a 10 bagger. So I mean, just think about that. It's like, in reality, if your actual goal is to have, let's say, a 10 bagger in a stock, you should then know that I would be forced to sit through 50% corrections or more sometimes. At least, a bunch of, let's say, 20 to 30% corrections. Over maybe months. Sometimes even a year. Then in order to get a 10 bagger, this is also a belief, like I talked about earlier, that in order to get a 10 bagger, one must take a huge amount of risk and buy a stock before some major catalyst might happen that typically has a very low chance of happening. I think people would I mean, nobody for some reason believes that a post discovery play has a much, much, much higher chance of becoming a 10 bagger than a pre discovery play. Hence, the typically why I see when people talk about 10 baggers, it's typically extremely risky stuff. If they hit, if they make a discovery. That might be true, but like we've seen a bunch of times, typically no pre-discovery play that makes a discovery they don't go up 1000% the very next day after a discovery is made. It may take weeks or months for the market to start pricing in what actually happened, because there are so many that sell on a 50% or a double, or they think about old don't forget to take profits. So there's a bunch of psychological stuff that let's say hampers a revaluation, because everybody has these beliefs that they think are right, that they must follow, etc. And that is one reason why it takes time for the market to price something in. Because Mr. Market has all these beliefs and the short-term focus. And that's why over the longer term, typically it becomes a weighing machine rather than a voting machine. Because at some point, the future is the present, etc. Share price beliefs. A rising share price is always good, and a declining share price is always bad. I mean, that is basically what almost everybody's talking about. What stock is going to go up tomorrow? What stock is going to go down tomorrow or next week? That is also one thing. It's like if there's at least two things that people are, I think most retail are actively hunting. It's 10 baggers without even knowing what the cases should look like for the highest probabilities of it becoming a 10 bagger, and then they also include short-term focus and always want to be in something that they believe will go up and never risk something that could go down. So basically they're hunting for something that they don't even know how they tend to play out, and in order for a stock to become a 10 bagger, they don't even have the necessary tools to actually be a part of it. So again, a belief of how a 10 bagger should be is produced or happen, that is simply not true, because a 10 bagger doesn't happen overnight. It doesn't go up 1000% in a month typically, and you don't need the highest chances of getting 10 baggers tend not to be in the highest risk plays, because like I shown before, discovery stories like Great Bear, and there's a bunch of others as well, they became 10 baggers after they made the discovery, or 20 baggers after they made the discovery. So if you just stop looking for 10 baggers in pre-discovery plays, I think you will do much better actually. I mean, heck, even Newfound Gold, which started out at 100 million market cap, from one fat bonanza hole, I think that went up like 500-600% in a year, and everybody said it was so expensive when it started off. So that one was quite expensive at face value after a discovery hole, and it almost became a 10 bagger within 12 months. Which again kind of proves my point. Uh, a belief is that a company going down in price is a negative thing by default and should certainly always be avoided. That's again what everybody is focusing on, the short term, and God forbid you own some. Nobody knows if a stock will go up or down. Just the idea of a stock possibly going down. And obviously that tends to, I mean, the belief that it will go down tomorrow typically is what follows if the price is down today. That is something, again, few can stand. Nobody ever wants to have a correction in any stock they own. And you can see this in stocks that have, let's say have quote good runs, and people get pissed or something that a correction comes, which there's always going to be a correction. Again, a 10 bagger has a bunch of corrections. The thing is that at a certain pace of share appreciation, if that never corrected, that would mean I mean, for example, my compounding goal is some 50% per year. I think that is achieved by 3.65% return on average per month. 3.65%. If a stock goes up 3.65% start of a month, let's say, if that would just continue to go up like that, I mean the return on a year would be, I don't know, thousands of percent. We have very weird beliefs how we think a good return is produced, and that ties into how a 10 bagger is produced. If we could average 3.65% per month, which is, you know, a snooze fest to most people, that would be extremely good returns over the longer term. That a short-term price decline equals a permanent loss. Like something is like if you own a stock, it goes down. There's like it would be the most terrible thing ever, because for some reason I'm assuming this is because people don't actually know really what they own or have conviction. They're definitely afraid that they are making a mistake, and if the price goes down, they believe that Mr. Market is right and they are wrong. Because they didn't sell and Mr. Market took it down. So the Mr. Market on that day is telling them they're wrong. Despite the fact that this market can be totally irrational and be wrong for months or even years on end before it starts becoming more fairly priced, like we've seen after an over 2-year long bear market. Every company didn't suddenly go down 70% in value over that period, but price typically did. And again, what is a permanent loss? That's basically a situation where you will never get your money back. And so risk to me is something going down that should go down and stay down. Everything will go down, and typically a lot of things will go up as well. But certainly not everything should go up and stay up. A lot of things should go down and stay down. The trick is obviously to spot the difference. Because in short term, I mean, that is just volatility. Price going up and down, if nothing has happened, no news is out, etc., that's just volatility. That's not a permanent loss if you're down. Same thing as, you know, when a stock is up and people congratulate people. I mean, if you sell, yes, you would have locked in that profit. But if I'm not selling if something has gone up, it's because I think it will go up even more over the next 6 to 12 months. So I'm not taking any victory laps, because I know that volatility can happen at any point in time. And it's not over until the case is over. It's not over until I sell and deem a stock to be, you know, I think I have a better place to put my money, let's say. Until then, you know, you can be up 10% on a day, and that's also, I think, an important thing. It's like don't cheer too much when you have a stock that goes up, because that might as well go back down tomorrow. Then you will have to, mourn that. Just look at it, you know, as what it is, which is volatility. You should cheer if a company becomes better. You should cheer if value is created. If price goes up, all else equal, the opportunity worsens a bit. If price goes down, all else equal, the opportunity increases. And yeah, people think that the only way to have very good long-term results is to avoid all short-term declines. You see that in the forums all the time. Everybody's guessing where the stock is going to go tomorrow. If people think there's a chance, because nobody knows, nobody on this earth knows where a stock is going to trade tomorrow or next week. But just the mere, risk of it going down, and the belief that this might go down, that scares the crap out of people. And perhaps even more importantly, people believe that one, or this is the, let me just read it, that one can get good long-term results despite correction, while it is thanks to the correction the long-term results can be even better. Maybe I worded this a bit weird, but it's like, I mean that's literally it. It's like people say, that corrections in price, again price, all else equals, like, yeah, you can actually have good long-term results despite the corrections. But it's actually thanks to the corrections and the volatility. If you use that, you can have even better returns. I mean, this is, for example, I'm not going to say what the stock is right now, but maybe you can actually see that. I should hide that. So this is a stock. It's like, would you be happy if you own this stock? Would you be happy here in this period? Do you think you would have made a mistake? This was a 41% correction. How many wouldn't think they made a terrible mistake if they bought somewhere around here? How many wouldn't say this was a terrible investment if they bought it somewhere along this time period and this happened? How many eggs wouldn't have been thrown in the forums and Schadenfreude and all that? This period in time, would people say, hey, this looks like a good investment? Basically, let's say, gone nowhere for months. Would you be enticed to buy this? Would you think that somebody sitting in this made a good decision? Or this period here, barely above where it was months ago, long, multi-month downtrend, a long correction, or kind of long correction with multiple smaller corrections in between. And from this point on, let's say you bought here, you held it here, you didn't sell because you thought that, hey, with time this looks really good, I think they're gonna create a lot of value, and therefore I believe that one day I will be up a lot in this stock. It's you think it's a fair chance of being a when question and not an if question. So you don't sell here, and then it goes like this, and everybody says, oh, you should have sold, obviously, it's down 46%. It's like, oh, you feel like a total idiot. It's like, oh, I watched this correct 46%. if I just took profits on the top tick, I would have avoided this and I could get in here. And that's what typically gets people to start trading all the time, because they have some, well, a belief that you can't have a big correction if you're going to have good long-term results. You see, everybody else has the main occupation of guessing where the stock price is going to go tomorrow or next week or next month. And you see a lot of people like, oh, geez, oh, I feel bad for the people that bought here. I feel bad for the people who bought here and didn't sell, yada, yada, yada. You're always going to hear that. But you hold on, okay? Hey, this starts to go back up. All of a sudden, if you actually bought the top tick, you're actually in profits. And then you go into another long correction, minus 47%. So now you experience this twice. Oh, if I only, oh, I should have seen the signs. People were selling, sell this, yada yada. People every day trying to predict where the stock is gonna go. And you're like, oh, I messed this opportunity up because it went up a lot and then it went down a lot again. Oh, if I only knew how to trade, if I only knew how to use some complex technical analysis or whatever. And there's of course going to be some people every day saying it's going to go higher, and some say it's going to go lower, and they act accordingly and typically try to get other people to do the same. So there's a bunch of noise on a daily basis. Hey, the same things happens again. But this time it doesn't actually correct. It just goes higher and higher and higher and higher, and then a big correction again. But then, yeah, then you're down 41.62% again. And the same thing happens. People who bought here, and now maybe you started to think that, hey, and now I really need to start trading this because you've seen, your gains disappear, etc. But let's say you just stick it out, because at any given point here, you think, hey, I think they're going to create more value over time, over the next 6 to 12 months. So by definition, I think the path of least resistance will be up. The gravitational pull will be up, because again, in the short term it's a voting machine, in the long term it's a weighing machine, and you just hold. And then, it almost gets back to this peak, and then an even bigger crash, 62%. I mean, if you take any of these episodes in a vacuum, I don't think anybody would say this could possibly have been a good investment. Because you have big corrections, you have long corrections. And everybody thinks, that's how we typically act. Because everybody thinks that, again, guessing the short-term price movement is the thing. So, hey, okay, I would get good returns in this stock if I just knew when the top was in, and when I should buy, and when the top was in, and when I should, sell, and then again when I should buy. So if I traded this perfectly, I would have good returns, which literally nobody on earth does, really. It's like, how on earth do you, like, okay, how could one be sure that this was a top? Yeah, it broke resistance. It broke resistance here as well. This was the bottom. When it broke here, this was a top. Here it broke even lower. So why wouldn't you think this was a not the bottom? And here it made some, topping candle, etc., etc. So you probably sold out here, perhaps. And who knows, when you thought, hey, now I think it's gonna go up again. Then it just, for whatever reason, gapped up and then just went higher, 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 higher. So why did it make a double top here but not a double top there? Why was this the bottom and not this the bottom? Why wasn't this really a top, but rather, a short term? I mean, that just lasted for like, a few days and then it went higher. And why wasn't this a top? I mean, you see big fat red candle like here. Why didn't it plunge I don't know how many percent. Why did it stop here and all of a sudden it just rocketed higher again? Relentless, yeah, I mean, look at this rise. And why wasn't this a top? Or why wasn't this a top? And then you go into another kind of nightmarish scenarios. Like, I think this is over a year. Massive volatility, up 30%, down 30%, down 25%, up 25%. Breaking below resistance, but for some reason this was a bottom. Uh, and obviously this was more of a trading range. So I guess again, if you try to trade it, whatever. But if you were actually a long-term value investor and think, hey, this is cheap, by default you would just buy the lower it went. You didn't even need to sell any of the top. You would just, hey, I'm keep this is so cheap. When it hits these cheap levels again, because we're assuming again your whole thesis was that they are creating value. So one would say that okay, value is going up, price is slightly declining with huge volatility in between. So I would much rather own the stock here than here because there's 6 to 8 months of value creation in between. So this price is much cheaper than this price. So in that case, you would actually if you have a position of 5% here, you maybe should have 8% here or whatever, because you factor in the price to value gap and expectations for the future. So it just kind of has this nightmarish whipsaw pattern for months and months, over a year, I think. Everybody says this is a dead stock. Everybody would say, like you always see, oh, the opportunity cost of having been in this stock, because that's how people look at opportunity cost. They look at the past, what has happened, even though the opportunity cost is at any given moment. The opportunity cost here is not this trend. The opportunity cost here is the price to value gap. If you can find something cheaper with a brighter future in light of the price, then this has opportunity cost. It has nothing to do with what has actually happened, but that's how people view it. So again, they always, for some reason, like look in hindsight and then say what the opportunity cost was. That's not how opportunity cost works, because we can't invest backwards in time. We can only do, on any given day, we can only set up the best way possible in light of what prices we pay for all potential securities we could buy and what our expectations of the future are. Future, not past. Anyway, so long grinding correction. Everybody probably ridiculed for even owning this stock. You had to see a lot of, let's say, false starts. I mean, 2 weeks you're jumping with joy because price went up, and let's say actually value goes up, which is more important in my opinion. And then you have this decline up. I mean, how many actually ended up holding this? How many didn't learn by this time that, hey, I should really trade this? That's the only way you could have made money over this period of time. And then boom, up again and up even more. So obviously any buy at any point in time, and if we zoom out, the trend all of a sudden becomes fairly visible, because this is Great Bear Resources. Any buy at any point in time, every single top ended up becoming a great return. If you bought here, you would have beaten the market handily. If you bought here, you would have beaten the market handily. If you bought here, any single top in this, if you bought here, you would have beaten the market handily. Of course, we know that in hindsight, but the whole thing is that since Kinross acquired it, their assumption, or I mean, they're voting with their feet, their money, they're saying that this was the actual value of Great Bear at this point in time. And you had price all the way down here just a couple months before Kinross is saying this is actually the value. This is pretty standard. This is, I would say, a pretty typical chart for a 10 bagger. It was not the traders who made the most amount of money in this stock. It was those who basically did nothing for, well, 2 years. Those who did even better than the ones who just bought at some point here and held were the ones that actually bought more when volatility was negative, when price went down. If you bought here and held it to the end, you would have made this difference here. If you added down here, you would have made more money from Great Bear by buying the dips. So the question then is, from a belief standpoint, are corrections good or bad? Everybody would say almost that correction is bad. That is their belief, that a declining share price is always negative. Because they look at what they had, not what they're gonna have. They're looking at the past. Oh, should have sold here, and now they are despondent and negative or whatever. But if this was just a straight line, if this was just a straight line higher, there would be a lot less opportunity to make money in Great Bear. And as you can see, typically you have these kind of consolidation periods, and then just wham. Another consolidation period with a COVID flash crash, and then wham. So you have these long periods where value typically goes up, sentiment is going down, price to value gap is going up, so risk reward and opportunity is increasing, meaning the longer this kept going down, the more value went up. You should have had a bigger and bigger and bigger position. Again, we assume that more value had been created here than here, and if the price was the same, this was obviously a much better buy, and then all of a sudden you know it revalue. The market again is a voting machine in the short term, driven by sentiment, and you don't really know when, but suddenly it can just, start to price in what is obviously there, let's say. You didn't need to know when any of these moves bottomed or topped or whatever. You just had to have some kind of conviction that you think maybe the price was always higher than the value was always higher than the price. Well, maybe not here, perhaps. But as long as you own something that is cheap, by default, the long-term risks are to the upside. And I would say it is infinitely easier to find something right now that you think is cheap, and a revaluation to the upside is more a question of when, not if, than guessing every of these short-term corrections, waves right. I mean, guessing this right, this was obviously a very short-term trend, guessing this up here first, then down, then up, then down, and that it would just keep on going, yada yada. That this was actually a bottom when it broke, let's say, well, perhaps not broke support, but like bounce, let's say. And this, okay, it broke higher. Why did that correct then and go down 48%? I mean, it broke higher. And this gap, I mean, you see it all the time. People keep, especially like Magna, they keep harping on about these gaps that must be filled, etc. So this gap never filled. So if you always think that a gap will fill, and you don't care what the price to value is, if this is dirt cheap right here, after a gap, and you're like, nope, every gap fills. Why even look at the price to value? That is just pure technical analysis. You're guessing that it's going to close, regardless of how obscenely perhaps undervalued it is. I mean, I guess this was a gap as well. That actually, hey, This actually almost closed. I'll give them that. This gap never closed. I don't know if this gap closed. Okay, now I find happen to scroll to another. I don't think this gap ever closed. This gap didn't close. If this is a gap, I don't know. I mean, this gap obviously never closed. Anyways, like, know what the case is. I mean, that's I guess my main takeaway here. And of course, again, this is the kind of stuff you'll see in 10 baggers. Absolutely horrible price action in any given time frame. But if you zoom out, this is a 10 to 20 bagger. The one who didn't try to guess anything other than, hey, I think this is still undervalued, would have made more money than any trader. Anyone who was consciously aware, perhaps a bit more proactive, realizing that, hey, the price to value gap is really large here or here, because value going up, price went down. They would have made more than anyone else, more than the traders. So it is again, this is how 10 baggers work. So if you can't stand any sort of correction, or if you, quote, just want to be in when it's going up and not down, you're probably going to have really, really poor returns. Really, really poor returns. You might get some things right. You might nail a top or a bottom here and there, but it's not going to add up to how the hodlers, how much the hodlers made. So, I mean, in my opinion, as long as something is incredibly cheap, it's a automatic, it's a buy by default. Then the question is to find the cheapest place or the highest value creation place. And obviously I prefer the ones that are both cheap right now, already based on what is known, and have a lot of growth in store. Because if I'm right on the growth, let's say, I'm going to get bailed out. And then I can use volatility to my advantage. So again, was this a bad thing to happen? For one who bought here, he would say yes. For one who bought here and realized this was an even bigger opportunity, he's probably going to end up making more money than if the curve just went like that. So for that person, this was good. He made more money from Great Bear because of the massive corrections. This didn't stop this. It just went like this before, going higher. There's a big difference between things that go down and should stay down and things that go down and should not stay down. So again, the most important takeaway here is the belief that share price decline is always bad. And everybody wants the share prices to go higher. Let's say Great Bear was overvalued here. Let's say all your stocks were overvalued. Similarly overvalued. Is that a good or a bad thing? From here, the future expected return might be, I don't know, this was actually pretty okay anyway. It's like, even if this is 1.5 years, and it's like, 50% return. Maybe your goal is 100% return in let's say 1.5 years. In that case, if everything is, overpriced in light of your return expectations or your return goal, there will be no opportunity, big opportunity in any play. So in reality, you don't even want all your stocks to just go higher unless value has gone up a lot as well. If price just went higher and they become actually overvalued, then the future expected returns are much lower. So it's thanks to volatility. Volatility in great cases are the best thing, especially declines, obviously. And again, it ended up here, but it sure took a crooked way to get there. It's this volatility that is not only, again, why most people can't even hold a stock. They don't even use the volatility, they get abused by it. They buy when they think it's going to keep going higher. And they might get, let's say they get a, I don't know when you would say this was a break. Maybe they buy here, hold, and they think, yeah, it's going to go higher. But then they lose their nerve, so they actually sell here, for example. A hodler who understood the case, saw the trajectory, saw that, hey, there's, I can see net positive news releases for the next 12 months. They're just going to keep on, they're just going to lower their average. And it's like, I have no problem averaging up if it is warranted. Maybe value went something like this. In that case, if you bought here and let's say the delta between price and value was something like this, maybe up here it was something like this, meaning the company had become much more valuable than price was reflecting. Then this is a better buy than here from a risk reward perspective. So a bunch of false beliefs a lot of people have, that the only way to have very good long-term results is to avoid all short-term declines, because that's what everybody else is focused on. So immediately people take this a belief, a truism. Their mindset is, okay, in order for me to have good returns, I must try to avoid all short-term declines. And by how do you do that is avoiding even the risk of a short-term decline. So if you think there's a 60% chance the stock might go down tomorrow, you're more likely to sell. And people did that throughout this whole journey here. And typically end up selling low and buying high. If you just looked at the price to value, you would by default just get an even better return, because the dip, a hodler that is also a dip buyer in Great Bear's case would have made more than the hodler, and all of them would have been done better than the traders. I'm pretty sure of that. There's no trader that made, I think, 10 to 20 baggers on any meaningful size in Great Bear. Some miscellaneous, of course, the belief that a low market cap equals a cheap stock with potential for good future returns. I mean, in some ways that is kind of true. Because it's easier to move a low market cap stock simply by the laws of big numbers. But it's like recently, I think bank success, advanced juniors with sunk costs are so cheap that even the most 5 million market cap juniors are expensive. Maybe not in absolute terms, but relative to the more advanced cases. Because I've talked about this, the sunk cost. Like, what would it cost for junior X with a market cap of 5 million to reach the same stage as a more advanced junior with a market cap 10 times higher at 50 million? It might take them 60 million with no guarantee of success even to reach that stage. And then you can add in the permits, etc., which is like, that could take years, not even a guarantee that you will get the permits anyway. So, I mean, this right now with inflation and all that, and with de-risked success, advanced plays being so cheap, I mean, I think most of them, majority, are way cheaper than the microcap companies. There's only a few microcap companies I think are actually cheap. Because you can't look at it in a vacuum. Where is the best risk reward? In the 5 million market cap or the 50 million market cap? But when you reverse engineer the success in the 50 million market cap, you'll realize, hey, either this is cheap or the 5 million market cap is actually expensive. And I'm not including, again, the sentiment swings, which, at 2016 highs, there was almost no more micro cap or under 10 million. But that is more of a pure trading sardine approach. And of course, if the market is shit and they don't actually can do anything, they'll probably just serially dilute. Of course, that a high market cap equals an expensive stock with low upside potential. I still get affected by this. Just look at this is I don't know, 300 million. It's like, how much upside can there be? I mean, there's a company with a 10 million market cap, but it should always again be seen in light of future value, and of course you should factor in the probabilities of reaching future value. What you see all the time, that the market is always right, yet we stock pick. I mean, everybody that says the market is always right also is typically a stock picker. And what is funny, and I do this myself, at the same time we complain about the market being wrong, whereas in reality that is the requirement for anyone to be a stock picker with perhaps above average returns. We need the market to be wrong, and the market, the stock doesn't know. As soon as we buy it, it just doesn't snap into being rational all of a sudden. Of course, everybody's talking about this short-term thing with up or downside risk, so I guess that is what is important and I should focus on as well. What everybody's talking about tends to be priced in, and that's typically a short-term thing. So if you're excited about news releases that almost nobody's talking about, and the more news releases you can see that nobody's talking about, is even better. Even better. You're stacking the odds in your favor, because sometimes they will care about what you're already caring about now. And if there's a bunch of, let's say, 8 net positive news releases you see coming out in 6 to 12 months that nobody's talking about right now, chances are, especially if it's already cheap, when 6 to 12 months pass, you'll have made money. The same people who didn't buy it because they didn't see the news releases today will buy it in 6 to 12 months when they can see it, and that comes into Mr. Market's focus. I mean, Mr. Market is basically ourselves with a short time horizon and a lot of fear and greed. Again, also we have this belief that if we are right, that needs to show immediately with a rising share price as soon as I bought a stock. Again, the stock doesn't know you own it. You might be 100% correct that it is cheap. It's a matter of when it's going to go higher, because this is just way undervalued. But that might take weeks, months, or even years for the market to get up to speed to your better assessment of the value. The belief that I can't be right if the market disagrees with me for weeks, months, or years. Obviously, if you thought the market was always right, I mean, I don't know how you would even make any money in Great Bear, because you would only you would only have FOMO and fear, basically. Trend is down, so things are getting worse, so I better sell. Oh, now things are better, so I better buy more the higher it goes. And then the next correction, etc. I mean, that's how you whipsaw yourself. My go-to attitude is the market is always wrong. And that's why I keep, tweeting, etc. about Mr. Market being so dumb, because I do think we need to cast off this belief that the Mr. Market, especially in this sector, is some rational brainiac, basically. It isn't, especially in this sector. It's a greed and fear monster that typically has no clue what something is worth, or where it's going in the next 6 to 12 months. And also some beliefs I think this actually is pretty true for a lot of people. Even I sometimes have beliefs like this, or had, let's say, belief that it can't possibly be enough to just have common sense, patience, and actually skip short-term predictions to achieve good long-term results. I think a lot of people have that false belief. it can't possibly be as easy as just buying something that is obviously cheap and then just wait for weeks, months, and maybe a year, uh, uh, and then make a profit, and pretty much forget about all the short-term noise. Don't care about where metals might be trading. Not care about this and that and blah blah blah. It's like, this is obviously super cheap. I'm just gonna buy this, and I'm just gonna wait until it's not cheap anymore. That is sounds too easy to be true. The belief that I need to have advanced spreadsheets and complex technical analysis in order to beat the market, because that's what everybody's selling. Everybody's posting these advanced charts. Everybody is saying they know how to avoid all the short-term losses and get all the rips, etc. And then they typically have some, maybe they have some service or whatever, learn to trade like the pros, etc. Whatever. It's like, I don't even have L2 or whatever it's called, level 2. I've never used level 2. My, my I try to make my investing process as dumb as possible, in the sense, no, I shouldn't say dumb, as simple as possible. Common sense. Is this cheap? Yes. Will it be even cheaper if they keep on creating value like this? Yes. Do I think at some point in time the market is going to figure that out? Yes. Do I know when? No. I don't try to predict all the short-term movements. I take advantage of when they happen. If it's a good cheap story, you don't need to predict when the downside comes. You just need to know what to do when the downside correction comes. And on average, well, maybe just 30% of the cases you'll actually end up looking right. You don't need 20 great bears in your portfolio. Great bear alone, if you, let's say, held it in a meaningful position, if you started off with a 1% position, let that ride, that would have added maybe 20% of your portfolio return. It would have paid for 20 other positions that went to zero. And still that took 3 years, because again, if you're gonna have a 10 bagger, that means you have to sit and not sell after a double, and after it doubles again, you can't sell either. By default, that's the only way you can actually get a 10 bagger. But like I said before, funny part is that most people who say they're actively looking for 10 baggers, they're afraid, quote, to chase. It's like you had to actually nail whatever bottom here in order to have good returns in Great Bear or any stock that ends up being very successful. I mean, that's obviously not the case. Was there a major difference of buying this rather than this? No. Were the returns poor if you bought this and didn't nail the bottom here? I mean, there's for sure difference, but it's like, is it, how big of a problem is it? You would have beaten the market many times over. You would have still had returns that you could expect after, in the average market after like 20 years or something. And what is the big problem? As long as the case is intact, let's say you buy here, you don't predict that it's going to go down. It went down. And now the price to value gap is even higher. So you just got served up with an even better opportunity. Not that you predicted it, but at the end of the day, you probably will have made more money because it happened. The only thing would be like, yes, if you went literally all in here, had no additional dry powder, that would be, well, in this case, it would have worked out anyway. But it's like, yeah, then we can talk about, corrections being by default bad, let's say. But if you think this is, good enough for a 5% position, maybe down here you should have 15. So at the end of the day, if this just kept on going like this, I mean, when you get back here, if this didn't happen, it just went sideways and then up, you'd actually made more money in Great Bear if you had this big correction. Because you would have loaded up with more than 3 times the amount of shares to set yourself up at 15% here. So just this dip would, if you knew what you were doing, realized the opportunity, boy, you don't need many of these dips. But you didn't need to predict it, because if that just kept on going, let's say, I mean, you'd have made a lot of money. It's just that you would have made even more. That's why I don't get it at all. It's like when you find a super cheap company where the risks are to the upside by default, people think you need to be out for every correction. If the risks are to the upside by default, why on earth would I trade it? If this was overvalued here, but it made a flag or whatever, broke higher, so it's going to go higher. That's just gambling, in my opinion. If this was actually overvalued here already, in light of how much value they created up to that point, buying that just because it looks like a breakout, that is gambling. That is not value investing, to me. Uh, Yeah, and again back to 10 baggers. This stock can possibly be a potentially high return investment because it's not extremely risky. Again, when people pitch 10 baggers, they typically pitch them as, typically pitch some super risky stocks, because in their mind, a 10 bagger is something that could go up 1,000% in uh, the next 3 months. But if you were actually looking for 10 baggers over 3 years, there's a bunch of much lower risk plays out there. And who could complain, really, if you get a 10 bagger and it takes 3 years? Even if you're up 150% over 3 years, that's way above the market average. And of course, why should I have good long-term results if my past results are poor? I do think that this is also one of those things that if you had, let's say, bad results, I think you just often automatically believe that you can't have good results. So you end up conforming to that belief. It's like when people win the lottery, let's say they get $1 million. If their identity is not, their self-identity is that I'm not a person I would expect to have $1 million. I haven't done anything special. They will find the quickest way to blow all that money. So their reality becomes more closely resembling their self-identity, meaning I'm not a successful person. So it's like you as much as anyone else could have really good returns. There's nothing stopping you, absolutely nothing stopping you. Except if you had not so good returns up until now, you would need to change your beliefs and need to change how you go about investing. The old I'm not a geo mining engineer or a fund manager, so it would be arrogant and foolish to think, let's say, I could do well in this sector. I mean, I've gotten that thrown at my face. He's not a mining engineer, he's not a geologist, he doesn't know anything. Yeah, but I'm pretty sure I'm beating their results. I'm very sure. Takeaway is, you don't need to be a geo. You don't need to be a mining engineer. You don't need to be a fund manager. You don't need to have gone to Harvard. Most hedge funds suck. Most hedge funds can't beat an index. Most engineers can't beat an index. Most geos certainly can't beat an index. Just because you know some tree of the whole, mining forest doesn't mean you're a good investor. If you just look at, hey, this project looks really good, since I'm a mining engineer and can see that, but it's like, yeah, it's fairly priced already, or maybe it's overvalued because everybody sees it's good. But okay, I'll buy that because I can see that it's a good project. Yeah, and you'll have, average or poor results anyway. Or a geologist like, I really like how this looks. Yada yada yada. It's like, yeah, this might have a pretty good shot at becoming something, but it's like it's already pricing in, I don't know, 20% chance of something actually working out, and in reality maybe the one would say the actual chance of success is like 10%. It's like, don't buy into that crap that you need to be a geo or a mining engineer or a fund manager or have some kind of, I don't know, accounting license or something in order to have good returns. If that was the case, every geo mining engineer and fund manager uh, wouldn't need to have the job they have because they would be so good at investing themselves. So don't let anyone say or tell you that you can't do something because you're not X or Y. Coping, yeah, this is a bit off topic, but like the old, don't forget to take profits. At the same time, you hear let your winners ride. I mean, you obviously hear. I mean, for example, it's like uh, after this, you would hear, well, you should all never forget to take profits. But when it, let's say, continues high or whatever, then it's like, yeah, let your winners ride. I mean, that's just how it goes. Again, it's like opportunity cost. People look in hindsight. Why would I sell on a double if the case got more than twice as good? Why should I let my quote winners run if it's overvalued? This is just coping beliefs because you don't really know what you're doing. If you always have some kind of assessment, what is the price to value gap? That is the only thing you should be focusing on. Not how much it is up or down from any point in time. Again, it's like, well, if sell half on a double, you'll sold here, for example. Maybe this was a double, and it's like maybe it was a lot better here, here actually, because it's much more advanced, etc. It would make less sense, more sense actually, well, kind of to sell on a double here, let's say, than on if you bought here and went here. Because this opportunity was probably much better than this opportunity, etc. So it's like nothing is fixed in stones, and that's why I don't use any fixed rules whatsoever. The only thing that remains is the future. The only thing we know is the price we're paying today. So unless and anything is either cheap or expensive, there are just two realities. Either it's cheap or expensive. If it's cheap, by definition, it's not a sell. If it's expensive, by definition, it's a sell. That is the value investing way. Maybe it was actually overvalued here already. Still, it went up. That's okay. Because I'm a value investor. I bought all the way down here, let's say. I didn't even need to catch the last thing here. Because I just went so heavy when we were down here. So when we were back here already, closing on fair value, you had made a fortune already. And maybe you sell up here not because the short doesn't look good. I mean, it's obviously ramping, but you think, hey, this is starting to get kind of expensive. Maybe the fair value is here. So when you factor in that this sector is volatile as hell, you know that there's probably just a matter of when, not if, this will actually go down a bit. Because, again, it's actually overvalued. People will run out of excuses to pay this price because nobody's gonna. Fewer and fewer people will come up with a bullish perspective on the price to value gaps. Like, yeah, you can come up with a lot of things. Obviously, a long rant. I hope you got something out of this. Again, it's like the main thing is that we have a bunch of beliefs and a mindset, and that dictates everything we do, and a lot of them are false, especially in the market, because that is, in my opinion, I mean, it's not because we're dumb that we don't beat an index. It's because we have dumb beliefs of how one beats an index. Main ones being you can't be in a short-term correction, you need to get every move right, etc. And that, for example, 10 baggers, they just happen. Basically, it's this is a 10 bagger and just keeps on going forever and ever. whereas in reality you have many corrections, many rallies as well. And in my opinion, what always should be the focus is that you should be focused in on what others are not focusing on, which is like the next 6 to 12 months. If you think something is cheap today and you think it's going to be worth twice as much in a year, and you're afraid of a decline in price in the short term, you don't even know how to get good returns. You would actually want a short-term decline. It's not the decline, it's not the short-term declines that are the problems. It's how people their belief about short-term declines. It's their lack of a proper response to short-term declines. It's seeing the belief that short-term declines are bad regardless of how the story looks. In crypto, for example, I don't buy any. I don't own any crypto, never owned any crypto, because my belief is that they can fall up to perhaps 99% or more, and maybe they should stay there. When you have some of the best, let's say, projects in a finite space, we see the inventories of metals are down. We obviously need commodities. So if there's a tier 2 to tier 1 project out there, or maybe actually less than that, of course it has some value. Because if we don't put more mines into production, every current mine is going to run out of ore and we won't have a civilization. That you can't say the same about crypto or Bitcoin. We have society has done or the human race has done very well without any crypto. That is not a necessary thing, even though it might have some benefits, etc. But it's like totally different risk reward. It's like gold. It's been around for 5,000 years. Betting against that is like betting against human history. Betting on Bitcoin to become the new store of value is betting on something that has never happened over 5,000 years, over thousands of civilizations, etc. happening. That the risk reward doesn't make sense at all to me, but hey. Yeah, thanks for listening. Consider me biased if I talked about some shares, etc. or companies. Bye.